Hello everybody, welcome to our latest Allsop PropChat podcast. My name's Ed Dunningham. Today we're going to be talking about rating. In the booth I've got our two Allsop rating experts, John Banbury and Ryan Stanton. Gents, there's a lot been going on in this world recently. Obviously you had a new rating list announced alongside the budget. You've got new multipliers being proposed, and obviously some changes to the relief system as well, all of which is coming in April next year, in 3.5 months' time. So, John, why don't we kick off just to headline and without too much detail, how does the rating system work?
Okay, well, what you end up paying the council is made up of your rateable value multiplied by the multiplier. And key thing to understand is both of those things changed on budget day. The announcement was made on budget day. They'll take effect April next year.
So the new list, I mean, it's only been out a few days, hasn't it, really? What have we seen? What are the big changes? Obviously, the old list was based upon the COVID years, which were tricky in themselves. So a lot of changes, I hear.
Yeah, so it's all about the rental value a couple of years ago. So 2021 was when the last list was valued, and that was mid-COVID, so rents were low. And now the values are based on 2024 values. So there's been quite a big difference, particularly sectors like industrial, which across the country has gone up by 21%. And we're talking England mainly here and not Scotland. 21%. Retail's gone up much less, by about 10%. And office overall 14%. And that's relatively static right across the country. The other sectors vary region by region. So, for example, industrial in the East Midlands up 18%, industrial London up 24%.
Should we drill into some of those sectors in a bit more detail? I mean, industrial is obviously the biggest riser, isn't it, in terms of the changes?
Yeah, so an industrial rent that's gone up by 25%. Most of the multipliers have gone down. So what you're going to end up paying is actually not a 25% increase. If it's gone up 25%, it's probably a 15% increase or thereabouts in your liability. But that's still quite a lot, particularly when you think about how industrial rents have changed over the last 3 years. So on top of let's say a 25% increase in rent, you've now got a 15% increase in your rates, and suddenly what you might already have felt were quite toppy rents are looking 15% less affordable than they were just before the budget.
That, I mean, from wearing my valuation hat, that worries me, because of course, as valuers, we look at the industrial sector and think, my goodness, there's been an awful lot of rental growth. But now, obviously, the rating system is going to apply more cost into the occupational position in that sector.
And look, you've got to think these are averages as well. So within that 25%, there'll be plenty of properties which are valued 30, 50% higher than they were last year. And they're the ones to really look out for, because their occupiers will be severely impacted by this change.
Okay. So industrial's the biggest sector that's been affected. How about retail? What's the position with the retail world?
Retail, we're seeing about a 9% increase across the country for retail. London is hit the hardest, as you would probably expect, with about 13%. And then you're seeing the northeast market coming at a very modest kind of 3% increase for retail. Interestingly, prime retail in your kind of south and southeast areas like Reading are actually down by about 7%. So that'll be nice news for, Reading occupiers. I think the main thing is that we're seeing a lot of really striking inconsistencies across the list in terms of how that's split across areas, but also, as John mentioned, these are averages at the end of the day, and various buildings that you would expect to go up by quite a lot haven't gone up so much, and ones that you wouldn't expect to go up so much have then skyrocketed.
Places like Bicester Village, a huge increase, but that's probably because it was undervalued in the last list as well. So this is kind of coming back. Yeah, there's a slight over-correction.
But I suppose there has been rental growth in the retail sector in the best positions, whereas other positions probably have flatlined or stepped backwards a little bit. So I suppose this underlies the importance of actually checking and reviewing the position that's been attached to you in the list.
So overall, the retail sector looks very inconsistent when you span it across the country and into the kind of various properties that fall within that. And it'll be interesting to see the impact that this has on those retail properties, particularly the difference between the impact on those smaller shops and the impact on the larger shops as well, and your big chains. And I think all of this goes back to ratepayers need to understand their bills. They need to understand exactly what they're paying and why they're paying it, and they need to know if that's right or not.
So do you think the inconsistencies in the list will give opportunities for challenge?
Definitely. There's always opportunities to challenge. You have to understand, first off, it's more or less based on the rent that you're paying. So if you're looking at your RV and it doesn't quite line up with your rent, that's a trigger for you to see if you can appeal that rateable assessment.
That sounds good. Good opportunity. Okay, so let's move on to the office sector. Again, a sector that's had a lot of changes over the last few years. How does the list look in that regard?
So it's up again, as you might expect with most sectors. Offices across the country have gone up by 14% on average. You're seeing kind of your prime city centre office stock taking the biggest hit. So City of London's up by 11%, Westminster by 17%, but perhaps probably the kind of biggest increase with inner London is actually the Camden market, which has gone up by 22%, which I know was something you were looking at as well.
Yes, that might be a Shoreditch, bit of a bouncy market, isn't it? It's been very popular and struggled a bit in COVID, and this is probably an overreaction from 2021 to 2023.
I suppose the other issue is that, the office market, particularly in central London, the best new space is in demand or was in demand at the valuation date. The secondary space, the poorer quality space was absolutely not in demand. So you'd have thought there should be big differentiation between those, the good and the bad there. And again, presumably opportunity for challenge.
Oh my goodness, yeah. Then you start getting into how the valuation office value property and what in repair actually means. Let's not get into that now.
We're not doing detail today. So where else is there to go to? Hospitality, obviously another sector that's been really challenged, particularly over COVID and since, and now with the cost of living crisis. How does the hospitality sector, of course, it's made up of different elements, isn't it?
The stick out one there is hotels.
Yeah.
And, COVID, obviously, hotels were very badly affected and their rental value was consequently very low in the last list. In addition to that, a lot of them have had relief. So the operating model of hotels has been profitable, which has pushed rents up disproportionately. 75% increases we've seen on the rating list on average and for hotels. So if you couple that 75% increase with taking away of retail rates relief, then they're seeing some really big liability increases in hotels.
That's a real concern, isn't it? But of course, the multipliers are also being rejigged. So maybe there's a bit of relief there, is there? Or is it still looking
Yes, so we used to have 2 multipliers, one for big, one for little. Now we've got 5, one for really big, one for big, one for little, and then 2 for retail, big and little retail. And the retail ones are sort of going down about 20%. The interesting thing in the budget, everybody thought the really big multiplier might go up by, might be 10% higher than the normal multiplier. In fact, it's only, 2p higher?
Yeah, 2.8 pence. And I think that is the kind of big headline message, is the changes weren't as drastic as we all expected. And I think that probably makes for good headlines in favour of the government. But actually, when you strip it back and you see the increases in rateable value, these operators are going to be hit really hard.
Yeah. And I suppose the interesting thing that you've taught me today also, chaps, is the fact that although Rachel Reeves has been putting up taxes on a lot of issues, the overall tax burden in the rating system has remained constant. It's just a reallocation of where that's being targeted on the different sectors and the different revaluation effect on offices, shops, hospitality and industrial.
Yeah, the rating is a £33 billion tax. It goes up in line with inflation each year, but that tax burden, or tax take, is the same each year. That's the idea. What happens every 3 years when you have a revaluation like this is you're just rebalancing which sectors are paying for most of that.
Okay, so what's the impact here? What should people be doing?
Absolute number one is people need to understand their bills. They need to understand what they're paying. They need to make sense of it and identify whether or not it is correct. Your rent is a imperfect kind of guideline as to whether your rateable value is correct. So if your rateable value is far higher than your rent, it probably gives you a good opportunity to appeal.
And there's also a deadline, isn't there? Obviously, the appeal system for the current rating list, you've only got until April to appeal your current rateable value. So it's a great opportunity to look at that.
Yeah, you can't affect the new revaluation until April, so everybody's focus now has to be on what they can do now. If you can bring your rateable value down now, there's a good chance you might be able to affect the future list as well. So you need to be identifying whether or not your value now is correct, and if you've made any changes to your property, you've got a building site next to you. These are all different things that you need to be looking out for to identify whether or not you can make some savings now in the last 3.5 months that you've got.
And to be honest, most people do always wait until the last quarter of this 3-year long valuation period to make the challenge.
And if you're successful in a challenge in terms of the current list, is it all backdated or not?
Yes, backdated to 1st of April 23, unless, of course, you only moved in after that. The other thing you want to look out for in what's been happening in the last 3 years is, have you done a refurb? Have you moved out of part of your office for a period? Because you can make savings against all of those things. People often aren't aware of them. Or even if next door is a building site and you're being disturbed by the noise there, all of these things can be claimed for.
So we've discussed the changes in the multipliers and the big multiplier and the small multiplier for the different size of rateable value. The one thing we haven't mentioned is, of course, supermarkets, which seem quite exposed to this higher rating multiplier.
Yeah, there was some discussion about whether they should be included in the higher rating multiplier or have a special exemption. In the end, they were included, so they will all pay the higher rateable value if they're over 500. What that means for your high street is you've got your supermarket paying the high multiplier next door to a shop who's paying rates which are 30% lower for the same value.
That in itself seems quite a fair way of doing things, charging the big boys a bit more than the little independents. But I suppose there'll be some feedback coming through from the big stores about that.
Yes, the Robin Hood effect, isn't it? Yeah. But yeah, it will redistribute the burden a little bit.
I suppose from the valuation perspective, just generally, just to throw my 2 pence in, is that the changes in the rating system will affect rental values. We have seen across a lot of sectors, certainly in terms of the best space, rental growth coming through across all the sectors. But of course, the sectors that have grown the most are now being burdened with the highest increases in rates, which logically should slow that progress. So it'll be interesting to see how this all pans out.
Yeah, what effect will the new increased liability for hotels have on hotel rents? You have this oscillating effect where it's overshot up and now it's going to overshoot below. And Kimmy Badenoch, did you not say the other day that the Conservatives were going to scrap rates on high street shops? What happens then? It just means that the same business model can afford paying a much higher rent. Great for landlords of high street shops. Is it going to happen? I think very unlikely.
So there have been lots of changes in the list, in the system. Let's just wrap up with what people should be doing, what people should be looking out for. What are the triggers in terms of making the best of the situation that an occupier's got?
You need to be looking out for your rent relative to your RV. That's a trigger. If your rent's much lower than your RV, it means your RV's been badly calculated, probably. If there are any things you've done to your building, like refurbishment or moving out of part of the property for a while, mothballing a bit, or if there are building works next door, these are all reasons for you to be able to do something to reduce your rates burden for the last list. As for what you can do with the budget information, multipliers and new RVs, it just helps you budget for the future. At this stage, you can't do anything about it.
Okay, so lots to look out for, lots to review in terms of occupational costs and checking and challenging. Thanks for listening, everybody. Any questions, do get in touch with John or Ryan in the Allsop rating team. And again, thanks for listening.